The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello everybody and welcome to another edition of the live advanced technical analysis course. This week is the first of a 3-week overview in terms of the webinars that we'll be going through. Today is the second of the 12 webinars titled Anatomy of Price Action and Trend Identification. Forex Academy is an online provider of educational facilities to traders of financial markets and cryptocurrencies. All of the material that we'll be reviewing over the next 3 weeks comprise tools and techniques falling under the subject of technical analysis. It'll be educational material, and the purpose of which is to get you, the audience, to familiarize yourself with these tools, these techniques, and these approaches in terms of how they can also be applied to financial markets, both from an analytical and a trading perspective. Before we continue, just a few housekeeping issues. Please feel free to ask any questions throughout the webinar. You can locate your chat box on the right-hand side of the screen. I'll obviously be able to see all of the questions. The challenge for me is to answer them. The live webinar is being recorded and will be placed in your members area once this webinar has concluded. Finally, we will be hosting, as is the case with each and every webinar, an extended Q&A at the end of this session. This will allow you to ask any additional questions, as well as giving us the opportunity to perhaps go into more detail in terms of responding to that question and perhaps even raising some form of a discussion, which ultimately I feel will be to the benefit of everybody attending. The course overview is the same each week, comprises 4 webinars. The first 3 consist of focusing on specific methodologies relating to technical analysis, so these can be viewed as the educational webinars. At the end of each week, which is on Thursday, there is a workshop which will review the tools, techniques, and approaches that have been applied and looked at over the course of the previous 3 webinars. This will run through the second week as well as through the third week. The slight difference at the end of the third week, on the final webinar, we will have an end of course workshop which will not only look at the techniques and the tools covered in the previous 3 webinars, but we'll look at combining and compiling a number of the tools and techniques that we have looked at over the entire webinar to illustrate how one can then look at building a very concise and very disciplined strategy towards both analyzing and trading the financial markets using technical analysis. In today's webinar, our focus will be principally looking at trends. We will start off by taking a look at the 6 tenets of Dow theory. It's very important for every technical analyst to be aware of these 6 tenets. These are essentially seen as the foundation blocks of technical analysis. We'll then start our focus and move into trends, looking at the 3 types of trends. Understand and appreciate the importance, the very important aspect of taking on board the view that the trend is your friend. We'll be looking at the different phases of a trend. Very important to be able to define a trend, understand a trend, and therefore looking at trend definition. So we will look at what is seen as the formal definition of a trend to provide the starting point, so to speak, of being able to both define and understand the trend in a more concrete and concise manner. We will then be introducing, just at the tail end of today's webinar, some additional tools and techniques that can be used to further facilitate your evaluation and your analysis of trends. These will be using trend lines and channels, as well as introducing the benefits of looking at the slope of a moving average. Technical analysis, as we saw yesterday, is the study of price action. We've really focused our attention on why price is so important. Just as a brief reminder, remember that price represents the summary or the conclusion of the market's decision-making process. Therefore, by looking at price at any point in time, we will be able to get an idea of ideally what the market is thinking. In other words, tapping into the psychology of the market. Because price is, or rather, because technical analysis is the study of price, it is very important for us to understand all aspects relating to price. If we are able to do this, this will improve your effectiveness in identifying conditions of strength and weakness in market activity. If you recall from yesterday's webinar, this was one benefit of applying technical analysis to financial markets. It is the ability to identify conditions of strength and weakness in market activity. When it comes to considering trend is a very important component in financial markets, and certainly an extremely important component when it comes to applying technical analysis. We need to therefore understand all aspects relating to trend, and this is really what we will be embarking on in today's webinar. From a trading perspective, trend following is generally regarded as the best way to trade the markets. And this is a message that we will continue to support and convey over the course of the various webinars. Now, the 6 tenets of Dow theory, as I mentioned earlier, are regarded as the foundation blocks of technical analysis. Charles Dow, who the Dow Jones Industrial Average is named after, started to collect tick data on the Dow in the early 1900s. Off the ticker tapes, he managed to compile a history of price data and started to evaluate price action. What he noticed was that there seemed to be some element of the market repeating itself, or a repetitive element to this price movement that he was analyzing. And in essence, that was really the start of what we now know as technical analysis. The building blocks, or the foundations, were laid down for the subject of technical analysis. Further study of price action then ensued, and essentially what developed over the next few years was a theory towards what the market is and behaves in terms of a focus on price action. And these are known as the 6 tenets of Dow theory. The first is that the averages discount everything. This was something that we looked at yesterday, that the market is always discounting future events. It makes absolutely perfect sense that because the market is always forward-thinking, it understands what information is coming about. It has certain expectations about what is likely to happen in the future. For example, if you're looking at evaluating what the Bank of England or what the US Federal Reserve is likely to do with respect to interest rates over the course of the year, there is a degree of expectations in terms of what the market thinks those central banks will likely do, and this will then have a bearing on the decision-making process around the assets that are likely to be affected. So the first very important tenet of Dow theory is the averages discount everything. The second is the market has 3 trends: up, down, and sideways. Major trends have 3 phases. The averages must confirm each other. Now, initially, this was a comparison between the industrial average and the transportation average, and essentially what the view was that if one made a new historical high, it necessarily needed to be confirmed as well by the other average. Obviously, the markets have grown over the years, and now we are in a much more complex environment when we are looking at the overall composition in terms of both asset classes and instruments that make up the financial market, but this idea nevertheless remains valid. Essentially, what the original concept suggested was that if one index, for example, managed to record a new high, and this was not followed through by the other average, let's say the transportation average, then this may have suggested an indication of perhaps some inherent weakness building in to that current uptrend. What we can do today, and certain topics that we will look at in later webinars, is how we can use the comparison between one index versus the price index to determine whether each of these indexes, and you can view price as an index, as to whether they are confirming each other. So that was the fourth tenet of Dow theory. The fifth tenet was that volume must confirm the trend. And essentially, this is more relevant certainly to markets such as equity markets than they are to foreign exchange markets, where we don't formally have any volume figures. But when you are looking at a stock and it spikes significantly in price, if there has been an increased level of participation, i.e. this essentially means that if volume has increased, then this really reinforces the underlying significance and the validity of that price move. If there isn't an increase in volume, then that would perhaps raise a question around whether this recovery or this move higher in price action has the ability to sustain itself going forward, and is it indeed a bullish signal. So volume must confirm the trend. The sixth and final tenet of Dow theory is that a trend is assumed to be in effect until it gives definite signals it has reversed. And this is a very important point that we all need to always remind ourselves of. What we never want to do is to look at preempting market conditions. Confirmation is ultimately provided by price, and this certainly also applies to a trend. Price will at some stage tell us that the trend has actually reversed. We can then change our focus, our viewpoint, as well as our strategies. So in front of you, you have the 6 tenets of Dow theory. In terms of what we will be focusing on in more detail today, because we'll be looking at trends, there are 3 aspects here that are perhaps more relevant for today's webinar. And that is, firstly, that the market has 3 trends. We'll look at this in detail shortly. That the market has 3 phases. And then finally, we'll always assume that the trend remains intact until we have enough convincing or confirming evidence that it has indeed reversed. Let's start off with the overview of the types of trends that exist in the market. You can see in the chart in front of you that we have 3, we can call them cycles, or 3 phases of price action by simply looking at price action from left to right. First of all, there is a phase where the market price action has been moving higher. No need for us to specifically analyze what we're viewing. Simply, we are observing prices moving from this point to that point. There is no doubt in anyone's mind that prices have moved in an upward direction. If we compare prices from these levels over here through to these levels over here, again, we can come to the conclusion that markets have been moving in a more horizontal manner or in a more sideways manner. If we then take price action and focus on the area of price, or the phase of price from that high through to the most recent low, there is no doubt in anyone's mind that during that period, price action moved lower. Very important to be able to understand the 3 types of trends that we have. The 2 more obvious ones are the uptrend and the downtrend. People often overlook the fact that even the fact that a market is moving sideways, that in and of itself is regarded as a trend. So those are the 3 trends that we essentially focus our attention on when it comes to analyzing price direction. Certainly, it is all down to the starting point and the end point that you look at in terms of defining the trend. Even though we have 3 internal trends, an uptrend, a sideways trend, and a downtrend, if I was asking you where price action had moved over the time scale of this particular chart, given that it was trading down at this level and is currently trading at this point, you could come to the conclusion that the market has actually gone nowhere over that time period and has in essence moved sideways. That could be seen as the broader move over that period. Within that broader phase though, there has been an uptrend, a sideways trend, and a downtrend. That then necessarily means that despite the fact that price action appears to have gone nowhere over this entire period of the price history that we have in front of us, there potentially, however, from a trading perspective, would have been 3 possible strategies that one could have applied. If we had correctly identified this uptrend and gone long, there was a potential that we could make money from that particular position or profit from that particular outlook. If we had correctly established a sideways move during this period and looked at range trading, something that we'll look at again in a later webinar, again, we could have profited from that decision. And then likewise during this down phase, if we had been able to identify early enough that the markets were likely to move down, there is potential that again we could have profited from a downtrend. So throughout that entire phase, it is possible that we would have had 3 different views during the lifespan of this chart that we have in front of us. This brings us back to a point that we focused on and stressed yesterday, that again, the other advantage of, or one of the other advantages of using technical analysis is that it allows you to adapt quickly to market conditions. So we could have had 3 viewpoints or 3 directional bias conclusions during the entire cycle of this chart that we have in front of us. So those are your 3 types of trends. The second very important point is to always treat the trend as your friend. We mentioned earlier that trend following is generally regarded as the best approach to apply when looking to trade markets. Therefore, you need to treat the trend as your friend, because essentially you'll be looking to trade that trend. Now, if we look at this illustration in front of us, what we can clearly see is that there appears to be 3 different components to price action. The first is this perhaps more horizontal move that we are seeing in price action. Let's assume we're assuming that the markets had been moving in a downward trend. At some stage, the markets then develop a very clear upward direction in price. In other words, a trend has been defined. At some later stage, once again, it appears that the market moves in a more sideways manner. This is a very realistic overview or illustration of how a trend unfolds over a period of time or over its life cycle. We can then say that a trend has 3 phases, as we've just seen in the chart. The one phase is known as the trend phase. We have a consolidation phase, and we have a reversal phase. A market or a trend will always be in one of these 3 modes. Now, if we just go back and look at this chart in a little bit more detail, and these explanations will become a little clearer very soon. Let's assume that the market has been trending down. Our focus as technical analysts is to focus on the evolution of price, or the movement of price over time. What we can see is that the market trades down to this particular low, corrects up to this point, and then continues to move down. It's probably expected. The market is in a downtrend, and for a market to remain in a downtrend, we need to see prices continue to move in a downward fashion. Prices then react up to this particular point over here, and then we see a pullback down to this stage. Now, what doesn't happen during this pullback is the market fails to move below the last, what we would call a trend low. Instead, it starts to move higher. And by moving higher, it actually starts to break through these levels of what we would call resistance that have capped any recent upside. This pullback is then known as a weak test of the downtrend. Eventually, price action starts to move higher, and once we get above this area of resistance, we start to see a very different behavior in price action. In other words, there seems to be a clear direction in price action. We've essentially gone from moving sideways most recently to now clearly moving up. We can then suggest that in terms of a trend reversal, following the break of this horizontal line over here, that reversal has been confirmed. In other words, the market has gone from being in a downtrend to being in an uptrend. We can then call that the strong reversal confirmation. Price action will continue to move higher, and at some stage we will have almost a mirror image of what occurred during this phase over here. Essentially, prices will rally up to that particular point, they will pull back to this, which is normal under a trend condition, and then start to push higher to generate a new trend high. Some resistance will come in and force prices to move lower. The markets then begin to recover, and what we notice in this instance is that the market first of all fails to generate a new high and also subsequently then breaks below this most recent low. We've gone from seeing a sideways move to a strong directional move to once again a sideways move, which then ultimately results in a reversal of the uptrend following the break of this low. And essentially, this is the cycle that a trend follows over and over again. A trend will always be in one of these three phases. Now, for us to appreciate where we believe the trend is in terms of which of these three phases, we need to understand certain behavioral elements around price action in each of these phases. One final point before we continue. We have three phases. We have a trend phase, a consolidation phase, and a reversal phase. What you hopefully can appreciate at this point is that certainly the trend phase is easy to identify. It is this portion over here where the market is moving in a clear direction. We've been in a downtrend, therefore this phase can then be viewed as a reversal phase, which eventually leads to an uptrend. During this phase over here, we then enter the consolidation phase. However, when we eventually break below there, we notice that the reversal is confirmed. So both the consolidation and the reversal phase are seen in both of these early start to a new trend and the more mature stage of the trend, which ultimately leads to a reversal. It is very important for you as analysts to be able to appreciate this underlying behavioral element in price, because in terms of observing a change in, or at least rather a potential change in market conditions, one very strong tool is to simply just ask yourself, has anything changed in price action? In other words, if you see a market that's been trending down for some time, and then suddenly the prices start to consolidate for an extended period of time, it is very clear that in terms of how price is behaving, some change has taken place. This is always an early sign that the market is potentially, in terms of its sentiment, either reassessing the view that it's maintained up until that point in time, which then ultimately potentially lead to a reversal, or whether that is just a pause and ultimately we will see a continuation of the trend. But your ability to be able to identify a change in a the underlying character of price action will give you an initial warning sign as to whether any potential changes are indeed taking place. Let's get a better understanding of the three phases of a trend. Now, first and foremost, what one needs to do when identifying and analyzing these three phases is apply the first step of a technical analysis approach, and that is to focus your attention on price. What you really need to do at this point in time is firstly establish what has been the predominant trend up until, and we'll start off with this area over here. We can see that prices have been moving down. So your starting point is you're dealing with a downtrend. What you observe in price is that the markets trade down to this particular level over here. They then recover and find resistance at this level. The markets then find resistance and start to move in a downward direction. That is expected because the underlying trend is down. Your next test will be to see whether the market will indeed break below this particular low, just to confirm that the underlying trend remains down and that price action is generating fresh lows in line with the underlying uptrend, or rather with the underlying downtrend. What we notice from this reaction high is that prices trade down to this level over here, failing to break this low. Instead, they start to move higher, and our focus of attention then needs to move to whether price action will remain below this low over here in terms of maintaining the current downtrend. We will see why this is important very shortly when we deal with the actual definition of a downtrend. The fact that the market then eventually breaks above this level perhaps tells you some important information. What we can then conclude once we break above this level, we saw earlier that confirmed a reversal to an uptrend from a downtrend. We can then come to the conclusion that we have completed phase one of a trend. Now, this illustration is a very powerful illustration in terms of how you should be using and viewing and analyzing price to get an insight into what the market is thinking and likely to do next. In terms of understanding what we are dealing with in phase one, the underlying characteristics that exist in the market at that time is that generally we should appreciate that a trend is difficult to detect at this stage. The market has moved from a directional downtrend to a more sideways outlook, and we're asking ourselves the question, is the trend down likely to continue, or are we seeing a change in sentiment that perhaps might lead to a reversal? Very few traders and investors tend to open positions during this phase. There is a greater degree of uncertainty, or you could look at it another way. There is a more even balance between bulls and bears. And because there isn't any clear direction in the market, most participants are not sure whether they should be siding with the bulls or siding with the bears, and therefore they decide to stay out. Economic news and cycles are generally still bad but improving. This point really just highlights a more macro, broader perspective in terms of the market, because remember, whether you're dealing with a phase on an hourly chart or a trend on a multi-year monthly chart on the Dow Jones Industrial Average, this logic and this market psychology is exactly the same. If we've been in a broader downtrend for a period of time, the financial press and the various financial television stations will be focusing more on a fundamental overview and an outlook that is still relatively negative and therefore bearish on that particular market. Perhaps, though, there might be one or two economists coming into the circle that may be suggesting that things could potentially be improving. Early signs are showing a growth in the economy that is beginning to develop. This is an extension from the second point, that very few traders and investors open positions in this phase. There is very little public participation. Certainly if you're looking at equities, there would likely be very little fresh investment decision making taking place by the public. And certainly from a trader's perspective, because the trend at this point remains down, most traders will still be looking to sell rallies. In other words, they'll still be of the view that the market is likely to move lower. That is really the underlying characteristic of phase one of the three phases of a trend. What happens though, as we saw earlier and discussed earlier, is that the condition changes once we break through this particular resistance level. We can very clearly see in this chart that we've gone from something that comprises more of a sideways move to a clear directional move once we get above this point. And again, by just simply observing two things now. Firstly, price action in terms of identifying your what we call your goalposts or your key resistance levels, your key support levels. Excuse me. We see that the market moves sideways. Here, the underlying characteristic of the market is very, very different. It is clearly focused in terms of pushing prices higher. And as long as that behavioral element of price remains intact, then we can be of the assumption that the market has indeed entered the second of the three phases, which we labeled earlier as the trend phase. The underlying characteristics of the trend phase is that in this instance, because we've switched to a bullish trend, markets exceed previous highs and a trend is identified. In other words, we see a clear direction develop in the market. Because we've essentially moved out of phase one and into phase two, the underlying sentiment has switched to bullish, and therefore traders now begin to buy as bearish sentiment fades. From a more macro perspective, for those economists who are perhaps savvy enough to identify a more global positive shift that was developing in the market, there would be a much greater appreciation that that has indeed taken place. This would be reinforced by the media, which will be reporting a much more promising environment. And then certainly the public begins to participate from an equity perspective. The market will then start to build on their investment portfolios, and public participation in the market will increase. You could also consider this as in another manner if we were talking, for example, in foreign exchange markets, and perhaps let's just assume that the euro dollar had been moving in a downward direction for some time. We've gone into a phase one consolidation phase. Eventually that reverses and prices start to move higher. Traders then adopt a more bullish view and they become involved in the markets. So public traders are synonymous in this particular discussion. And as we just state here, traders are now buying the dips. What we will see at a later stage, when we cover the very important subject matter relating to patterns, we'll be able to further fine-tune our evaluation of phase one, phase two, and as we'll just see now, phase three, in terms of applying reversal patterns during the reversal stages, and then consolidation or continuation patterns during phase two to further enhance our ability to analyze these three phases. From a trend perspective, this is the most powerful and profitable phase of the three. And that makes absolute sense because just simply in terms of the ground that is covered, price territory that is covered during that phase, it will always be the greatest or greater than the territory covered by the phase one, or as we'll see very shortly, in phase three. This then also reinforces the point that we made earlier, whereby trend following is generally regarded as the best trading approach to apply to financial markets. It is principally because it is the most powerful in terms of direction once a trend has been identified and confirmed. And from a trading perspective, it provides the greatest ability to profit from a move in price action.